Hello and welcome to the Jerroms Miller Tax Hour, where we bring together like-minded professionals in all areas of tax with the aim of achieving greater collaboration. Today I'm joined by Sharon Cooke from 2020 Innovation, and we're talking about the Labour Manifesto, the Labour statement that was made recently, as to what we're likely to see in the autumn budget. Where should we start? Is it the autumn budget or the autumn statement? The autumn statement.
Budget.
Is it?
Yeah, I'm calling it a bit of a trick-or-treat affair. Day before Halloween.
30th of October, yeah.
Yeah, so I'm thinking perhaps more tricks than treats in this one, Nick.
I'm feeling that way too.
Yeah.
I'm not feeling that positive, but good for me because I'm going to get loads of work until the budget.
Well, I think we've got just over 80 days, haven't we, for any planning.
Yep. Which is not long, especially if we want clearances and all the rest of it, like we always talk about. So where should we start? Rachel Reeves' speech. What did you think? First female Chancellor.
Yeah, I thought just as a moment, I think that's really, really exciting to be seeing the first female Chancellor do her thing. And putting politics aside, I was really, really impressed with the speech that she delivered a week or so ago. I liked the power that she put into it and the balance that she put into it. I imagine that took a lot of work to deliver the statement in that way, and I thought it was, very cleverly done. I was impressed.
Good. She does have some economic background, I think. Bank of England, HBOS, and obviously an MP for Leeds and Budsey. So hopefully we'll get some good things. I mean, it seems like, not getting political, but a lot of people I speak to are feeling like there's quite a few changes that need to be made. So we'll see what comes out of.
Yeah, I mean, she's talking about fixing the foundations and being very clear that what she's just announced is not the end of the story by far. So I think we've got a lot coming on 30th of October. Yeah,
I mean, comments from her like tough decisions ahead and that.
Yeah.
I think there's a lot of, I don't want to call it negativity, but there's a lot of expectation of tax increases.
Yep.
Let's put it that way.
Yeah, she started on the spending cuts, and I think there's going to be more to come on tax now. And be interesting to start to comb through it and see where we think that might be.
Yeah, I mean, this is the first Labour government we've had since 2010. And that's pretty much when I started my career. So, so this is kind of, for me, a big event because, I shouldn't have said that. Actually, cut that out. But yeah, I mean, 14 years under the Conservatives, basically, isn't it? So, there's a lot for them to fix or whatever they want to call it.
Yeah, and I think ups and downs, and we're moving into a new vision now.
Yeah.
And there will be winners and losers, but short term, it seems like we have a gap that needs to be plugged, and I'm not sure many are going to come out of the next budget full of the joys of spring.
No, definitely not. And with one thing I have thought about more recently is about tax policy, and because you can't just raise tax rates across the board and expect to raise revenue as well. It doesn't work like that, does it? So you've got people like the IFS doing their studies. You've got Office for Budget Responsibility. There's loads of people, government departments that that are required to make sure that what they're actually doing is going to help the economy and not just cause everyone to leave the country because they don't want to pay tax here, kind of thing.
Yeah, it's a very delicate lever.
Yeah, I have to say I've become more and more interested in that stuff because I don't know how you can get it right every time, and in fact I don't think anyone has got it right every time.
And ergo, where we are.
Okay, shall we jump right in? Shall we talk about, I think, capital gains tax from the work I do, because I'm very transactional based and reconstructions and EOTs, management buyouts, all of that stuff. So I hear CGT every day.
Yep.
And that's one of the taxes that they haven't talked about, saying that will definitely not increase rates.
Yep.
There's a list of them that they won't change, or they've claimed not to change, which is corporation tax.
Corporation tax, or maybe loop back to. I think they're a bit half in, half out with corporation tax. But income tax, national insurance, VAT, they've pledged not to increase the rates. Of course, as we know, going back to levers, what happens to thresholds?
This is the thing. You can say we won't increase rates, but then you've got what if they just remove a relief all of a sudden,
Yeah.
or
Yeah.
personal allowance changes, and so yes, they're still technically sticking to their manifesto, but the real money in people's pockets can still change, can't they? Regardless. So.
Absolutely. But to your point, CGT isn't protected, inheritance tax isn't protected, so they're ones
They're
we
the big
probably
ones
need
we're
to be
expecting.
watching out for the 30th of October, I would think.
Yeah. So capital gains tax. When was it? It was the Office of Tax Simplification, when it existed, did a report talking about CGT and aligning the rates with income tax.
Goodness, blast from the past, but yes, we did see that, didn't we?
So I think
Yes.
that's where the first time in sort of for some time that I've seen that kind of announcement.
Yeah.
And that's kind of been going off in the background for quite a while. When they first made that announcement, there was a lot of feeling that rates were going to increase, and that was 3 or 4 years ago. They did change business asset disposal relief in 2020, which is about as much as we got after the OTS report.
Yeah.
Whereas now, I think people are expecting an increase.
I think so. I'd be astonished if there's not. The question's perhaps when.
Yeah.
Have you got a view? Do you think it'll be mid-tax year? Wait until April next year?
I think the answer is we're going to get an announcement in the budget.
Yeah.
The question is, will it apply from budget day?
Yeah.
Or will it apply from the 6th of April?
Yeah.
You don't often see them changing rates mid-year.
No.
Something like an income tax rate, they tend to, it makes it a lot more complicated to do mid-year changes.
But we have just been
CGT
through
isn't.
it with NI, haven't we?
Exactly.
So
We can't rule it out.
nothing, I mean, different political party, but nothing's off the
Yeah.
table. And you can imagine, can't you, if they say we're increasing capital gains from 6th of April 25,
Yep.
that period between 30th of October and 5th of April,
You're just going to fire sales, aren't you?
yeah, there's going to be a lot of activity, and they'll, of course, be very mindful of that.
Yeah.
So I think it could go either way.
I do, but saying that they won't change mid-year because it makes things more complicated, arguably it's easier to change CGT mid-year because it's more of a transactions-based tax.
Yeah.
So if I'm a betting man, I'm going to say they're going to change it from budget day.
Me too, on that
Okay.
basis. It isn't like the income tax and the NI, and the fact we've seen it happen recently with NI.
Yeah.
It feels very doable
Yeah, I think it is.
for capital gains. And do you think they'll go for alignment with income tax?
That's a big increase. That's
Isn't it?
double.
Yeah.
20 to 40%.
Yeah. And I've
I'm not convinced it would be that much that quickly.
And I've read if we go for the 45% as well,
Yeah.
we have the highest rate of capital gains tax in Europe. So that is a big lift, isn't it?
When was the last time we had it that high? Was it sort of early 2000s, I think?
I think even I can call myself a youngster for that question. I don't.
I'm sure I read it. I read it somewhere.
We read it from the good old days. Not recently.
Yeah.
Certainly. Anyway.
I mean, it has come down, hasn't it? It was at 1.28. So
that's pretty recent, isn't it? That was for this tax year, I think.
well, they had 28 on the residential.
Yeah.
At one point, it was 18 and 28
Oh yeah.
on everything.
Right. Yeah.
Yeah. So
Yeah. It's hopping about.
it is a bit, but yeah, straight up to 40 or 45,
Ouch.
possibly. But that would be quite painful for quite a few people.
What sort of planning do you think will go on in your world?
That's the big question, isn't it? What planning can we do? So we've obviously got people in the middle of transactions or even in the early stages saying we want to do this and we want to push ahead. Most people, before we had Rachel Reeves' speech, were saying we want to get this done by the end of September. That almost arguably gives us a bit of leeway.
Yeah.
Now we've got until the end of October to get those transactions done. I think the easy answer is those people who are already considering a transaction, accelerating it is not really an issue other than the fact that you need to get the work done.
Yeah.
If you're doing clearances, HMRC can take 30 days. I wouldn't be surprised if HMRC start dragging their heels a bit on things like that. They have 30 days to respond to statutory clearances, or most of the ones that we put in. So,
Yeah.
if someone comes to the table and says we want to do a transaction and we spend How long do we think we have?
Just
over 80
days,
Yeah.
I'd say.
So if we spend a couple of months actually talking about actually what we're going to do, we're out of time. So yes, we've got 80 days, and yes, you can do things within 80 days. Normally, I say to do a transaction quickly with clearances, you need 6 weeks minimum. So it's possible, but you need to start straight away.
Yeah,
That's the
we
problem.
need to crack on. So I guess a lot of focus on those transactions already in play.
Those transactions in play,
Yeah.
let's get them done, and especially if they've already started designing the transaction, if they've already found a buyer. The ones that are going to be difficult are ones who want to pursue a third-party buyer, and they haven't found a buyer yet, because it's not that quick to find a buyer just like that. But that could lead people into saying, well, why don't we consider an EOT? Or we do have a management team, so why don't we sell to the management team? So I think that's possible. The other issue is when you do things like management buyouts, EOTs are slightly to the side because, as it stands, there's a 100% relief from capital gains tax. So there's no tax at all on an EOT, whatever your limit. And I think that's why EOTs might increase. The problem, and I've always tried to push this with EOTs, and plug the last podcast we did. We had Campbell and Neil talking about EOTs, and they've worked on EOTs since before EOT relief was a thing. So they were selling into employee ownership when there was only, the incentive was because of the benefits to employees, not the tax relief. And I think the biggest thing I always talk to clients about is making sure you're doing it for the right reasons. The tax is only the start. You now have if you sell into an EOT, you now have a business run for the benefit of all employees, and you can get massive benefits out of that.
I bet.
Motivation, I'm not going to rehearse them, we could be here all day. We've done another podcast on that. But if you're going to go the EOT route, you really want to be pushing the benefits to the employers, not necessarily the tax benefits. And therefore, it's not always the best long-term solution. So whilst I think we'll get an increase in EOT, I almost want to talk people out of it and make sure they understand what they're getting into. Not just you're doing this for a quick sale to crystallise. And also, why bother doing it into an EOT? If CGT rates go up to 40%, let's say, unless they touch EOT, or the legislation with the employee ownership, you still got 100% relief. So we don't need to push EOTs.
Good point.
Arguably. MBOs I've had a bit more thoughts about, because if you sell into an MBO, you've now got a management team running the business, which if you're going to push them ahead now, are they ready? Again, the point, generally an MBO, and again, if you're trying to find bank finance within 80 days, you're going to struggle with that as well. So an MBO is likely to go ahead with maybe some cash up front if you've got any, plus some deferred out of future profits. If that's the case, and your management team's not ready, who's going to deliver those profits? So again, it's not just a case of let's just do it to hopefully save an extra 20% in CGT. There's a lot more commercial issues around it.
I would think so. And I also wonder if people's attitude to buying businesses will change as we're seeing tax policy change.
Yeah. I mean, it almost gives, this getting a bit corporate financy, but it almost gives the buyer it gives them some negotiating power. If you want to do this quickly, this is the price. And even then, you're kind of negotiating on ifs, buts, and maybe. So, I think there's a lot around CGT, and I think a lot more will come out. I'm just trying to think if there's any other ways that you might. I mean, I'm talking about business sales. So, what about someone who's just got a second home that they want to sell? How do you accelerate that?
Well, probably going to be in the hands of the legal profession. And again, finding a buyer. Property is becoming a bit of a hot potato at the moment, isn't it?
Yeah.
I mean, I suppose there's all sorts of things people might do to try to crystallise gains now. I suppose it's really important to remember disposing to spouse, gifting to spouse isn't going to trigger
That's going to do nothing.
No, so it does need to be...
What about selling to your kids then? Why don't we just sell a second home to our child?
Yep, so that would trigger a gain, absolutely. mean, again, we've got to think through the commercials, haven't we?
Yeah.
Yeah, but
I guess the problem is what you could say if you're that worried. Firstly, I'm just trying to think if there's any anti-avoidance around this. But if you're worried that CGT rates will go up before you get the house on the market or before you actually find the buyer and exchange contracts, why not sell to your children now, and then they'll sell it in 12 months' time or something? That's not going to achieve anything, though, is it? Because they're just going to have the uplifted.
yeah, we've still got the uplifted.
No,
Well, they'll have a higher base cost.
Yeah, they'll have the base cost. So let's say you've got a 500 grand house.
Yeah,
Sell it to your kids now. Let's say you bought it for 100 grand.
yeah.
I start this and then I think, have I made these numbers easy for myself?
It's okay. We're 400,000. So far, so good.
£400,000 gain. You got.
Yeah,
We're residential, so 24%.
Yeah,
I haven't made those
we're
numbers
not.
that
We're
easy.
not going to do that, are we?
No. So what's that? 96 grand in capital gains tax. I know.
It is very good. Yeah.
So we've paid 96,000 in capital gains tax.
You didn't factor in the 3,000 annual exemption, but we'll assume it was already used. Shall we?
They've already used that.
Yeah. Okay. Yeah. All right.
So we've got £96,000 in capital gains tax. They've sold it for 500k, but they've got no cash because the kids haven't got 500k. So how are they paying for it? There's the market value rule, which says we have to impose market value.
Yeah. If there's family relationships, yeah.
So arguably, you could just say, well, we're just going to gift it to them.
Yeah.
So gift them a 500k house. There's no cash in play, but they've got a £96,000 tax bill. Unless you sell the house before April, you're now going to have £96,000 and no cash, which needs to be paid by January 26.
No, 60-day rule now, isn't it?
Oh, you got 60-day rule? Oh, no. Oh, I'm stuck
This
on
planning
property.
but this shows how complicated tax
Yeah,
is, isn't
exactly.
it? And how all these rules
Yeah.
intertwine. And I'm also, when we were going through that then, I was beginning to think like you, is there something that's going to block it? Because is
Yeah.
this a transaction with a tax purpose? And we're quite reactive recording this podcast. It's an area that needs more thought, and I think we'll see a lot of capital gains planning happening over the coming weeks, but remembering things like the 60-day rule for property, exemptions. I've recently been talking about cryptocurrency.
Oh, no, don't.
But that's a really interesting area of gains, I think. And apparently 1 in 5 adults own even a small amount of crypto. Yeah. And a lot of their advisors...
Definitely not me.
Yeah, or me. I talk about crypto. I kind of think I don't really know what this is.
Yeah.
But a lot of their advisors wouldn't know. So if we're looking at, capital gains levers, it could be a good question to ask. But anyway, the reason I raise it means I've recently been looking at the share disposal rules. So we must remember matching, and if an individual looks to dispose of a share holding to trigger a gain, if they then buy it back again,
Bed and breakfast thing and all that.
It's not going to have the desired effect. We need to remember the same day rule, the 30-day rule. So there's a lot around capital.
There's also the
planning.
intention rule, isn't there? So even if you're not caught with 30 days and you buy it back in 31 days, if HMRC can show that there's an intention, it doesn't matter what the time limit is.
True.
So yeah, this is difficult.
It's not easy planning.
Yeah.
It needs...
I think even if you can come up with an answer, I think cash flow is your issue, especially on property where you've got a 60-day rule. And it would become very costly to say, well, we've got a 60-day rule, we're going to sell in 30 days, but the budget's now, so we'll transfer it to our kids. Then you've got all this conveyancing, and it's just not...
And all the commercials. So, the kids,
exactly.
And if there's a family breakdown, it's...
Yeah,
there's a lot to think through.
What's the term?
Don't let the tail wag the dog.
That's the one.
There we are. See?
So I think there are things that possibly can be done, being careful of the commercial side.
Yeah.
But at the same time, is it going to be worth a while? And we haven't even talked about using trusts to transfer things into trust, but I'm not a trust expert, and generally I think trusts are not a good tax planning tool.
Well, we're certainly seeing them clamp down. I know we're going to talk about inheritance tax in a moment, but part of the new government's policy is to end the use of offshore trusts to avoid IHT. So we know that's coming anyway. And with all of this, going back to our CGT planning, anything that any capital asset holder does now they're doing it with the same uncertainty we've been talking about. We might be gifting to kids or disposing of share portfolios, and we have the budget, and capital gains isn't mentioned. I think that's quite low probability, but it's an important
possible.
point. And certainly for anyone giving advice at the moment, that disclaimer is really, really important, isn't it?
Definitely.
Hugely important.
So I think from the work I do, people will definitely try and push ahead with the transactions they've already got in mind.
Yes, makes sense.
But whether or not it's even possible to do something before the budget, if you're not fairly far down the line already.
Yeah, I think timescale, sensible planning, and like all those commercials around it, it's going to be challenging, I would think, in an 80-day time frame. But I'm sure there will be some conversations to be had.
Yeah. Carried interest. I say carried interest like that because I've never ever done any work with carried interest, so I'm absolutely relying on you.
Well, I'm in the same boat really. We know it's within the private equity sector, so it's very, very specialist. And my understanding is it's effectively a route where what could be considered to be performance-related pay is getting pushed through a capital gains route. Yeah. And again, the new government saying, well, they're calling it a loophole. I understand it is legislation, but that legislation is going to change, and this flow of revenue that looks like income is going to be taxed as income.
Yeah. From the outside, that just makes sense. From what you've just explained, if it looks like income, surely it should be taxed as income, even though, yes, fair enough, the legislation currently is that it is a capital gain.
Absolutely.
So I can see why they're calling it a loophole, but I don't know enough about the rules to actually be able to give any authoritative answer on it.
It's an interesting area, I think, though, and actually coming back to your point about the earlier OTS report on alignment of capital and income tax rates, that that carried interest loophole closing is very much targeted at income that's currently getting taxed as capital that perhaps should be taxed as income. And that might also be something that we see in the budget if we don't see alignment of rates.
I was going to say, because if they align the rates, what's the point?
Yeah, it kind of does put it whichever pot you want. It won't make a difference, subject to reliefs, I suppose.
Yeah, and that's actually brings me on to what we were talking about earlier in the office about transactions in securities, anti-avoidance. All these anti-avoidance rules that, because for such a long time we've had an income tax rate higher than capital gains tax, we've developed various anti-avoidance rules. I mean, transactions in securities is actually, I think it was the early 60s it came out. So that's been around for a while, but it's been added to over time. The targeted anti-avoidance, targeted anti-abuse rule for liquidations, the anti-phoenixing rules, that's newer, 2014, I think.
That sounds about right. So that was like
around
an old ABCD, wasn't it?
Yeah. So all of these anti-avoidance, if we align the rules, how much concern are we going to have with anti-avoidance rule? Sorry, if we align the tax rates, how much concern are we going to have with these anti-avoidance? Probably not that much.
So you can see it could be done in the name of simplification.
It would help simplification, for definite. However, one of the things we did say on transactions in securities, it converts a capital distribution into an income one. So if you were to apply EOTs as an example, if we keep EOT relief and HMRC were to argue that transactions in securities applies, it's not that they are converting capital to income and yet we're still paying 40% or whatever the rates will be. It's that we're now saying it's income and therefore the capital relief isn't available. So if you've got a transactions in securities case involving an EOT, that would be absolutely catastrophic. You thought you'd had 0% tax and you're paying 40 or 45%.
Yeah, that's disappointing to say the least, isn't it?
So that's where these anti-avoidance rules will still have a place.
Yeah.
If you've been able to rely on a capital gains relief.
And I'm sure the Chancellor's very mindful as well that aligning the rep tax rates between income and capital, it might be simplification, but we've then got the risk of the innovators and people they really want to attract and keep in the UK going, you know what, the tax cost is so high, and taking themselves and their businesses elsewhere.
Well, that's the whole, coming back to the policy thing, isn't it?
Yeah.
Like, yes, we can increase capital gains rates, but if we do that, then we're going to push all the entrepreneurs.
Our high net worth individuals just going to relocate. So it's a really, really careful balance, and I'm sure one of the reasons the budget's a bit later than we were expecting is there's a lot of head scratching.
Which, to be fair, makes me think, well, maybe this government know what they're doing, because they're actually giving themselves the time to actually analyse what they do before they put it out.
Let's hope.
Remember when we had like 3 budgets in about 2 weeks?
I do. That was
So
that was a
hopefully we won't
happy
have that.
moment, wasn't it? Well, I hope we don't relive that again,
Yeah,
ever.
yeah.
That was, exciting.
So yeah, maybe that extra time is
Yeah.
a good thing for tax policy as well. So
Yeah.
that's good. Furnished holiday lets, sticking kind of with capital gains, but moving into a bit of
I
everything.
suppose capital gains is a big part of the FHL world. So what was really exciting a week or so ago is that we've, for the first time since the spring budget, actually seen some draft legislation. I don't know about you, Nick, but I've been pulling my hair out with everybody having every question under the sun. I'm like, we have 3 paragraphs. 3 paragraphs.
We don't know anything.
That is it. So it's been, again, and a bit like we've been talking about capital gains, it's really difficult to advise and to help FHL owners plan, and we don't know.
Yeah, exactly.
So now we've got draft legislation, we've got an explanatory note, we've got a policy paper, we've got some information.
Yep.
Which, that's wonderful.
It is.
Really
so
good.
what we're doing, we've got the finance cost restriction, which now will apply to FHLs.
Yep, so
which
if
it
we've
didn't
got any
before.
interest costs restricted to the basic rate.
There's not been that much talk about that one. Maybe that's the most minor of the changes. Capital allowances, that's more involved.
I think there's a lot of furnished holiday let owners that are breathing a sigh of relief. So a lot of the conversations we've been having at 2020 Innovation with our property sector group that we run is furnished holiday let owners that have made sizable capital allowances claims. And were expecting capital allowances to go and sort of poised for potentially quite a big balancing charge coming in on 5th of April 25. So what has now been confirmed is that isn't going to be the case. So that's a piece of, a little silver lining, because of course these FHL owners, they are going to lose all their tax advantages. That remains the case. But if we've got a capital allowances pool, that will remain in play beyond 5th of April 25. We won't be adding any more assets to it. We'll go to domestic items relief as for any other landlord. But that pool, we can continue to claim writing down allowances.
So we've still got writing down allowance, which is still giving us some relief. But the biggest, I don't want to use the word sigh of relief because I keep using the word relief, but the biggest sigh of relief for landlords is that they've not got this massive balancing charge, which they maybe couldn't even cash flow, let alone.
Absolutely. It could have been a real problem. So I think that piece of the legislation is a lot better than it could have been. So that's
But
that's
what
good
about
news.
Everybody trying to make huge capital investments now, claiming the capital allowances before budget day? Or even just capital allowances experts sort of using this as a marketing tool for the next 8 days.
I'm sure they're going to be using this as a marketing tool between now and 5th of April 25. So it would appear, though we were talking about this earlier, weren't we, that we've just always got to be so careful. Again, we're going into this unknown and we don't know what will happen, but it will appear as at the moment there is nothing to stop an owner of a furnished holiday let working with a capital allowances surveyor or otherwise to identify any plant and machinery within their property that they haven't previously claimed on, pooling it and claiming capital allowances, getting the relief in 24-25. So we might see a sudden rush to identify and claim on plant and machinery within FHLs before 5th of April. But the disclaimer, we just need to be cautious. I'm sure there's a lot of capital allowances surveyors out there that are saying it's a brilliant idea. They were saying it's a brilliant idea last month before as well, when we really didn't know. Make a risk-based judgment on that, I would.
Because I think the biggest question is whether we get any anti-forestalling that basically says anything from the date that Rachel Reeves made her statement. That would be, I would say, as far as they can possibly backdate any anti-forestalling. Then there could be some anti-forestalling from budget day itself. And if there's not, then the rules just apply. You need to make your claim. But one thing that happened with business asset disposal relief in 2020, when it went from entrepreneurs relief, if you wanted to make a claim under section 169Q, you had to make that claim before they made the announcement. So if you look at capital allowances, if you want to claim AIA, do you actually have to claim it, not just have identified that you're going to do. You need to put your tax return in before budget
That's a
day.
really good point.
And
Of
that's
course,
gonna
those
be-
tax returns are not going in until,
Yeah.
many months yet.
Presumably, there's going to be some landlords who have put some money in, haven't actually got a capital allowance expert to come in and look, and maybe they've actually done this expenditure back
Yep.
in 23, 24.
Yeah.
So there might be some scope for those people.
Yeah, a lot of them have spent a lot on these properties,
Yeah.
refurbing, really nice fittings, and
Yeah.
there's potentially a claim to be made. But
Yeah.
again, early doors here. Let's
Yeah.
proceed with.
I think
caution.
that's the big message. There's almost certainly, maybe not all of these changes, but certainly some of them will have anti-forestalling rules.
Yeah.
So even the planning that we do, we can do our best.
Yes.
But we're not magicians. We can't avoid anti-forestalling rules.
No, and we do now know a little bit more about the anti-forestalling for disposals of FHLs, don't
Yes.
we? And business asset disposal relief.
Yeah.
Yeah, still a bit of a odd worded one, I would say, but they're effectively saying that we cannot trigger a disposal in 24-25 that realistically is happening in 25-26. So no using artificial methods to accelerate a disposal.
No, but this is still better than when we had the spring budget, when at the spring budget we thought BADR was gone from budget day.
Yeah, that was one of the interpretations. It was just
Yeah.
so unclear. Back to the three
Yeah,
paragraphs.
exactly.
What did that one paragraph mean?
Yeah.
It could be read in so many different ways.
Exactly.
So it's better than we thought again. So I suppose going back to capital disposals, we know for FHL we've got until 5th
We've
of
got until April, haven't we? Yeah.
But it's make sure it's done, completed, everything is unartificial before such time. But again, talking back to real life, my understanding is a lot of these properties are incredibly profitable.
Yes.
The owners have got no interest in selling them.
Yeah,
The
yeah,
tax shouldn't be driving that decision. So
Yep.
I don't get the feeling at the moment we're going to see a rush
No.
on the disposal point.
Because that was when we, again, I'm thinking back to the spring budget when this stuff was announced, we did a group webinar that afternoon before we'd actually had a chance to read these 3 paragraphs. We literally just had the budget where they mentioned that BADR would cease, but we didn't know that it was going to cease from straight away.
Mm-hmm.
My immediate thought was, hang on, if you don't get rid of BADR straight away, everyone's just going to want to cash in, and then
Yeah.
you're going to have a massive problem with the property market again.
And we've not
So-
seen that, have we?
No, so that's good.
Yeah. Well,
Yeah,
yeah,
kind
it's.
of.
I think it is good that tax isn't driving that
Yes.
behaviour. So a bit more information wrapped up with FHLs as well. So as expected, that income won't be part of income for pension purposes.
Yeah, that's going to
forward.
affect some people, because I mean, it's been ages since I did any personal tax work, but I did have clients who basically lived off FHL income and made pension contributions. So
Yeah.
they pretty much can't make pension contributions now.
No, and we're going to talk about pensions as well in a mo, aren't we? But yeah, pensions and FHL overlapping could be a bit contentious. And I think relatively unlikely that we see losses in these FHL businesses, but it's appearing that if we've got a carry forward FHL loss as at 5th of April 25,
Yeah.
that can be offset against the general property portfolio, including the FHL that becomes part of the general property portfolio.
Okay, so just to explain that then, at the
Yeah.
moment, before we do anything with FHLs, we have to ring fence overseas property.
Yeah,
We then have a separate ring fence for UK property,
yeah,
a ring fence for UK FHL,
yeah,
and a ring fence for overseas FHL.
yeah.
So we've got 4 different potential loss
At
pools.
least 4 different property
Yeah.
businesses, and we could have individuals with more if they've got some properties they own directly, some they're in a
Yeah,
share of a
yeah.
partnership. So yeah,
So what we think the legislation will do is basically take that FHL, the overseas and the UK pools, and basically amalgamate them with the
Yeah.
UK and overseas
so
property pools.
those FHL properties will become part of your general
Yeah.
property portfolio, and the losses will be offset against those profits, it appears, which, if that is what's going to happen, that's more relaxed than at the moment, because you
Yep.
couldn't set an FHL loss against a non-FHL
Yeah.
profit. But again, a bit hypothetical, because
Yeah, I was
we
going to say
don't
there might be one winner in every
Yeah,
100
yeah.
FHL owners kind of thing.
Good for
but-
them. Yeah, absolutely.
Okay, so I think that kind of covers the major changes on the FHL side of things.
Yeah.
I mean, the other points we talked about BADR on FHLs, but FHLs actually benefited from most trading business CGT reliefs. It's not just BADR. It's the one that I did come across, because I came across the legislation a few months ago of what reliefs, CGT reliefs, I can't remember the exact section number, but what CGT reliefs apply to FHLs. EOTs are not one of them. It's the only one I know of that is not by the time I get to budget day, was not one that could be relieved. Having said that, I can't imagine a single FHL business being something that an EOT would work for.
Well,
so
it's not my world,
why.
but
So you don't generally have that many employees in an FHL business. That's just me being sad and actually getting interested in something.
demonstrating you're running these properties as a commercial venture a business might become a...
And with employees
timely.
to meet your limited participation fractions. So, I think you were always going to struggle with that one. Okay, so we've covered capital gains, we've covered FHL. One that, had our VAT director being here, I'm sure would have a lot to say about VAT on school fees.
So we're going to have to brave it.
Yeah.
Yeah.
She sent a couple of emails yesterday, quite, I don't want to say frantically, but frantically talking about all the changes because there's some big news.
Well, back on 29th of July, the line was drawn, wasn't it?
Yeah.
We were sort of expecting it to be, but it's been very clear that from it's 1st of January, isn't it, the start of the...
So it's for school terms starting from the 1st of January.
Right, yeah.
There's VAT. And it's not just that. I'm not sure I realised that maybe this is a change, but that it's also boarding fees. I thought they weren't going to do board. I thought the idea, most people were worried about tuition fees and maybe not. They wouldn't touch boarding fees.
They've been clear the boarding fees are in.
Yeah.
So there are some bits that are excluded. So books, not in. I've read nursery fees, not in. Wraparound childcare, I think it's being called, is not in.
Okay.
So there are some bits that are excluded, but you're right, they've made it explicit.
I think the major costs.
Tuition and boarding fees.
Yeah.
For school terms starting Jan 25 and onwards, including any prepayments towards those fees made on or after 29th of July.
And that's the big news. That pretty much takes the planning off the table. So there were I know a couple that Daphne was helping with prepayments before the 29th, so they might have just about made the cut. But even then, I know of via Daphne, I know of other planning that had been taken place with prepayments, where even though the prepayments had been made, the contracts were probably not sufficient to actually. I think technically they weren't, because the contracts weren't sufficient enough. They weren't genuine prepayments, and therefore will still be subject to that. Yeah. And there's people who've, I'm sure Daphne said, some people have made a prepayment of 8 years.
Wow.
So
just logically, I'd be surprised if that isn't going to be challenged.
This is the problem, and when we did our other podcast with Dan Needle, I'm plugging all the podcasts at the moment. It's fantastic.
They're good podcasts.
But this is exactly what we were saying. Yes, maybe there is some planning you can do, but even that is. I mean, we've got the anti-forestalling rules now, so that's taken that planning off the table. But certainly the more aggressive planning was always going to be problematic, I think. Yeah. And some people, and I think including Dan, thought pretty much all the planning was going to fail.
Yeah. It was there was going to be a risk attached to it. Yeah. I would think. So
VAT on school fees is in. It's coming in from the 1st of January.
Yeah.
The other thing I did pick up as well from Daphne was, if you no longer want your child in private school because you can't afford an extra 20% VAT, you actually have to give a month's term's notice. So anybody who wants to take them out before January actually have to give notice within the next 4 weeks.
Wow. Did Daphne share what she's seeing in that sector? Are the private schools passing the full 20% on, or are any taking any steps to absorb?
I don't know that yet. I think it was an IFS report that was done into the VAT on school fees, which suggested that maybe 14% would be the net increase. So the other thing for private schools is that they might actually be able to go back a few years to actually reclaim on some of the acquisitions that they've made.
Okay.
Again, If I'm the one
Yeah.
talking well about VAT, it's a problem.
No, but that sounds like a viable...
But you can normally go back, can't you?
Yeah.
If it's the capital goods scheme, is it 10 years you can go back? Something like that. Don't quote us on any of this.
Yeah.
Where's Daphne?
We're missing Daphne right now, aren't we?
But that's what they've got to benefit from in year one.
There. So yeah, there could be some helpful offset. And of course, we've also heard for the private schools, they're going to lose their charitable business rates relief from next April. So not aligned with January, that's on a tax year basis.
Yeah.
But of course, nobody pays their business rates in advance, so there's no
exactly.
no planning to be done on that.
But long story short, with the VAT on school fees or for private schools, it's not a great time for them. But
no,
hey-ho.
no. Some
we saw it coming. Let's put it that way.
Yeah, some important
nobody's
choices
surprised by
being
that.
made by families over the coming weeks and months. I'm sure.
Yeah, I think I can't remember the numbers now, but there is a there was a statistic about how many people would actually take their kids out of private school if this happened, and I think the idea was that it wasn't overly cost sensitive, because again coming back to policy, if you put VAT on private school fees and everyone starts to move out of private school, there's not enough spaces in.
No, I've read that you could end up with state schools swamped.
But the idea was that this VAT was going to provide more funding to those state schools. So we'll see. But, here's another one that, if you thought I couldn't talk authoritatively on VAT, non-DOMs is even worse, I think. So I'm going to put you on the spot and say, what's going on with non-DOMs?
Well, this one, relatively straightforward to keep up with, I think, because what our new Chancellor is saying is she's pretty much continuing the plans that had been outlined by the Conservative Party in the spring budget.
Right.
So we'd already done a fair bit around this foreign income and gains regime, premise being that non-domiciles will start to lose access, well, they will be losing access to the remittance basis from April 2025.
Yep.
And that remains the case. So coming in instead, we have a 4-year FIG, foreign income and gains regime, that is available to individuals that have been UK resident for less than 10 years. So for anybody eligible, that means they can have 4 years where their foreign income and gains is not assessed in the UK, even if they are remitting that.
So that's if they've been they've been non-resident for 10 years.
Yeah.
Come to the UK and you still have 4 years.
Get 4 years
You can remit all your money.
Income gains can come in and it won't be taxed in the UK. But from year 5 onwards, you're going to be taxed on a worldwide income basis.
Yeah.
Here.
Sorry to interrupt.
No, that's right.
Does that mean you've been non-resident for 10 years, you come here for 4 years to do something, and then you leave 4 years less one day kind of thing?
Happy days.
Yeah.
Yeah.
Okay. Fair enough.
As long as you don't come back within 10 years.
And then you go, you can be here 4 years, then go away 10 years, come back 4.
It's quite extreme tax planning, isn't it? But yeah, 14-year policy.
Yeah.
Yes. So we also had transitional rules for existing
Yep.
non-doms who may or may not have been here for 10 years already. So let's assume they'd already used up their 10 years, so had already gone through their 4-year FIG effectively. What we're seeing now at this transitional stage, effectively, some changes being made by the new Chancellor, and some of them are to be confirmed on 30th of October when we get to the budget. But one of the proposals the Conservative Party had put out there was that for those existing non-doms in the UK that were going to be affected by this, their foreign income and gains that's being assessed on the worldwide basis in 25-26, because they're not eligible for any FIG regime, they'd get a 50% discount. That's been immediately deemed too generous. Forget it, you're not having it. So it'll be 100% worldwide income and gains from 25-26. Now, coming back to capital gains.
Yeah.
Capital gains is going to be a hot topic, I think.
Yes, definitely.
So we knew for gains there was going to be some element of rebasing available. What's come out from the 29th of July is that the appropriate rebasing date is to be confirmed.
Okay.
So we don't know what the assets can be rebased at, and that's going to be confirmed.
Presumably
at
it's
the
going to be
budget.
something like 29th of July, 30th of October budget day, 5th of April when it comes in.
Yeah, I don't know. The inference before was 5th of April 2019.
Wow,
So
okay.
That was under the Conservative Party, so
Right.
I don't suppose
Okay,
it's
so
going to be.
okay. So that actually
Um,
brings in the increase in values of all these assets for the last 5 years straight away. Wow.
Yeah, well, yeah. So to be ascertained on the 30th of October,
Yeah. Okay.
and we were also expecting a temporary repatriation facility for those individuals that have unremitted
Yeah.
income and gains, to encourage them to bring those funds here to the UK. So there was talk of having this available for 2 years, for
Yep.
25-26 and 26-27,
Yep.
and a low 12% rate during those 2 years. That plan has now got a question mark over it.
Okay.
New government are saying they plan to do something, but they will come back to us on what the rate
Right.
is and the timescale of the relief. So
Yeah.
we're still waiting on budget
Again,
day.
it makes sense to do that though, doesn't it? Because it brings more investment to the UK. Which
You
is
would
what we want.
think. So again, it's levers, isn't it?
Yeah, yeah, yeah.
They perhaps think that initial proposal too generous. So big picture, we know the remittance basis going.
Yep.
There will be a 4-year foreign income and gains exemption for those that have been UK
Right.
resident for less than 10 years going into that. But then the transitional rules and the temporary repatriation, that's got a bit foggier until we get to
Yeah.
budget day.
So we've got some things to wait for, but
To keep us on our toes.
exactly. Good
Yeah.
wording. A little bit conscious of time. We do still have a couple of other taxes we want to cover. So let's talk about the business tax roadmap briefly.
Well, I'm not sure there's going to be too much of excitement in there.
No.
So we know the annual investment allowance is going to be retained, full expensing is going to be retained. Where I think we might want to be watching out is corporation tax, and we said we'd come back to that.
Yeah.
So when we look at the Labour manifesto, they have promised not to increase the
Yep.
main rate of corporation tax, the 25%. I would therefore suggest the 19% small profits rate and marginal relief for the companies that are in the marginal relief band. Yeah, that might be something that has an impact in the roadmap. Whether it be instant over the 5 years
Yeah.
or not at all, we of course don't know.
Yeah. To be honest, from my perspective, from dealing with corporation tax, we had a marginal relief years ago. Then that all went and we had one rate, which made things nice and simple. And then we came back into marginal relief, but with much lower figures. So the 19% at 50,000 and 25% above 250, whereas before it was, what was it? It wasn't 1.5 million or something. So it was a lot higher in the previous regime.
Yeah, it was 1.5.
So you almost think to just put one rate is going to have less of an impact this time. But it will. I mean, the issue is obviously we're talking about the smaller companies who a 6% difference matters.
It feels like that wouldn't be their target, but it would certainly be simplification. Something that's been just keeping me busy for the last couple of years has been lecturing on the associated company rules.
Exactly.
And they cannot be described as anything other than complicated.
Yeah.
So once we go to a single rate of corporation tax...
If we go.
Yeah, well, if or when.
You've made we're definitely going.
Well, more like logic, I guess, I'm thinking here. If we were to do that, you can see that it would be classed as simplification.
Yes.
I was thinking about two things at once. That's what made me do that.
Okay.
Because we use the associated company rules elsewhere as well, I think, for employment allowance. So they wouldn't be gone altogether, but it would be a lot less contentious than it is right now.
I think that's it. I mean, I get a lot. I don't do corporation tax day in, day out, and I don't really touch compliance anymore, but I still get asked questions about the associated company rules, and they are so complex when you get into the nitty-gritty of it all.
Minimum irreducible groups.
Yeah.
Yeah.
Horrible legislation.
Horrible stuff.
Yeah, I think that's what most of what there is to say on the business tax roadmap.
I think they'll probably comment on R&D, but we're sort of expecting that to be maintained.
Yeah.
So R&D patent box will probably get a mention, but at the moment, I don't know about you, Nick, but I'm not getting any spidey senses. I feel like R&D's probably had enough change recently.
I was going to say there was a lot, wasn't there?
Should we leave it alone for just give it a year
Please
off?
do.
Yeah, I don't know.
Definitely. What about SDLT? There's not a huge amount out there on this, but there is some non-UK stuff.
Yeah, so we know, well, it was in the Labour Party manifesto that for non-residents purchasing UK residential property, there's going to be an increase in the surcharge from 2% to 3%.
Yeah.
So on top of normal SDLT rates.
Right.
So I'd assume that will come in upcoming legislation associated with the budget.
Yeah. Okay. So that's SDLT. So we've not yet got much to say on SDLT. we'll see if anything more comes out of the
It could, of
budget,
course, just get wrapped up in any property changes happening
Yeah,
because
exactly.
of CGT or FHL. So we've got to keep an eye on SDLT and when it impacts. But yeah.
Pensions. Have we got anything more to say on pensions? I think we have.
Yeah, pensions. It always comes out, doesn't it, before any budget to go, is it going to change? Is it going to change? But I would think it's up there with the capital gains tax, the inheritance tax, as a strong possibility. It's a what. And I think there are some things that could be introduced relatively simply.
Yes.
And there's other measures that, when I think about them, it tangles my brain. I don't think they would be particularly simple to introduce. So we've got the rules around inheritance tax and pensions. They're quite generous at the moment. So
Very generous,
whether we
I think,
see passing pension pots onto families, attracting IHT in more circumstances going forward, that could be interesting. The rate of relief, we're starting to see a lot in the media again about this, aren't we? Whether higher rate, additional rate taxpayers will continue attracting 40-45% tax relief within their annual allowance. Yeah,
and also the lump sum. I did read about the lump sum potentially going completely. A tax-free lump sum at the moment, 25%. So if you've got £1 million pension pot, you can take out 250 grand on day one if you want. Flexi access rules say you have to be at least 55, I think, don't they still?
Is it?
Or has it changed?
We're just too young, aren't we? It's 55 or 57.
Okay, maybe it went. At one point it was 55, but it could have moved up to 57.
I think maybe it is still 55 as at today.
Yeah.
But that kind of age range.
Yeah, exactly.
Once you start flexi
Mid-50s.
accessing when you're eligible, you can either instantly access your 25% or move it into a drawdown, and every time you draw down,
Every drawdown is 25%
free.
free.
It's a very, very generous.
Yeah, exactly. And to get rid of that straight away, that's a huge change.
It would be a lot, wouldn't it?
Yeah. So we think there's definitely going to be some fairly substantial changes to pensions.
Yeah, we don't know, but it feels as though they must be in this head scratching that's going on within Westminster at the moment. I would think it's on the agenda.
Yeah. One final one then, making tax digital. I don't want to say it, but I have to.
I know. I think we've got to address it, and I appreciate there's a huge range of views, and so obviously during the election we saw HMRC in a period of sensitivity, or PERD as they used to call it, and that stopped the HMRC MTD campaign. They've been very, very keen to encourage agents to take part in testing for the clients that will be mandated in from April 26. And certainly with the agents that I'm seeing, there's reluctance, I think, to go into testing at the moment. And part of the reason for that is this moving goalpost. And we need more in the way of certainty that April 26 actually means April 26. And I just think there's been a few... I know this isn't necessarily a popular view. And after the period of sensitivity, HMRC are back on the road saying it's going ahead, you should be preparing, you should be testing. And absolutely, when we get comfort in that start date. But we did see before the election, Labour put out a plan to close the tax gap. And that referenced the fairly scathing National Audit Office report into the costings of MTD and how all of it, the timescales, the costing, were just out of control. And we saw in that plan to close the tax gap reference to making better use of tech, making better use of AI, and having achievable timescales for delivery. And then, interestingly, in the Chancellor's speech on 29th of July, she didn't reference MTD at all, but there's back to using tech and AI smartly within HMRC, and news that we'll see a new office for value for money. And that was also another criticism of the MTD.
I was going to say, value for money is a big thing, I think, in terms of collecting taxes and how you, as you say, how you use tech and AI to actually make this more efficient. Because I know back when I did personal tax, which I accept was a few years ago, I used to phone HMRC. About 2 rings later, I'd have someone on the end of the phone doing whatever I needed to helping, change a tax
living
bill or
the dream.
something. Exactly.
Living the dream.
Now I can hear across the office in the personal tax team, they're just like, 40 minutes, still on hold. Just like, and you just think,
Yeah.
I had it easy because I know that individuals who didn't have agents still had sort of long wait times. But things like that, to be able to make everything more efficient. And they've done things like you can change tax codes online. I had to try and change my tax code online. It didn't go well. I ended up phoning them anyway.
Did you? Yeah. They really don't like that. I don't know if you've seen the press releases. No.
Have you tried this online? I was like, yeah, I did.
Yeah, sure.
I've been trying, I swear.
And that you can get boxed into a corner.
Yeah.
So I absolutely believe and know making tax digital for income tax will happen.
Yes.
I think for me, I want to get through 30th of October and see if anything is said. Because, like we were saying earlier, 80 days. And I think in the roadmap for agents between now and April 26, 80 days is a relatively short period of time.
Exactly.
And I think if it were me, I would just want a little bit more certainty before I start reorganising workflows for quarterly submissions. And it's good stuff. And when we're ready to go,
yeah, exactly. It's
digitalisation
about sort of timing and timescales.
It's just about when to take that leap, I think.
Absolutely. Okay, I think that brings us nicely to a finish. Thank you very much for joining us. Hopefully everyone's found this interesting, because I certainly have, and taxes that I don't get involved with, I'm now actually starting to understand a bit. So,
well, I've been talking about EOTs. It's
there you go.
Thank you for having me, Nick.
Thank you. And thank you everyone for joining us on the Tax Hour. Hit the like, hit subscribe for the next upcoming episodes, and hopefully we'll see you again soon. Thank you.